Welcome to the Dinar Daily, where we explore the complex mechanics of the financial world. Today, we're taking a deep dive into a topic that generates a significant amount of online discussion: the inner workings of foreign exchange systems at major U.S. banks. You've likely seen the chatter, the screenshots, and the persistent questions. People notice when their banking apps undergo maintenance, or when certain foreign currencies appear or disappear from online lists. These small digital changes have fueled a massive wave of speculation, particularly around currencies like the Vietnamese dong, leading many to wonder if these are signals of something major on the horizon. But to understand what's really happening, we need to pull back the curtain and separate financial reality from digital rumor. Our journey begins at the very foundation of the global currency market. It's essential to understand that the exchange rates you see on your screen are not set in a vacuum. Every single day, U.S. banks, from the largest institutions to smaller regional players, plug into a vast, decentralized global network. This network is a complex web of real-time data feeds, where information is exchanged constantly, sometimes multiple times per second. These feeds are the lifeblood of the foreign exchange market, carrying data from international financial hubs, major currency trading platforms, and central banks across the world. It is a 24-hour, 5-day-a-week operation that never truly sleeps, reflecting the constant ebb and flow of global commerce and investment. Within this massive flow of information, there are key anchor points that provide stability and official reference. Institutions like the International Monetary Fund (IMF) and central banks such as the U.S. Federal Reserve play a crucial role. They don't dictate the minute-to-minute value of most currencies, but they do provide official reference rates and data that banks use for settlement, reporting, and risk management. Furthermore, global clearing houses, which are neutral intermediaries that facilitate secure transactions, also contribute to the data pool. When a bank sets its internal price for a currency, it is synthesizing all of this data: the live market rate, the official reference rates, and its own operational costs to arrive at the number you see. This leads us to one of the most misunderstood concepts in foreign exchange: the role of the commercial bank. A common misconception is that banks decide the value of a foreign currency. The reality is precisely the opposite. Banks are primarily reactors, not actors. They are conduits for the market, not the source of its movements. Their automated systems are designed to react instantly to the prices being established on the global stage. The actual, underlying value of a currency, whether it's the Vietnamese dong or any other, is determined by a vast array of macroeconomic forces. The policies of that nation's central bank, its balance of trade, its interest rates, and the collective sentiment of millions of investors worldwide. When you walk into a local branch or open your app to exchange currency, the rate you are offered is known as the retail rate. This rate is different from the wholesale, or interbank, rate, which is the price banks use to trade large volumes with each other. The difference between these two rates, often called the spread, is not a sign of manipulation. It represents the bank's own markup to cover the costs and risks of facilitating the transaction. These costs include the labor to handle the cash, the security to store it, the price of hedging against sudden market swings, and a small margin for providing the service. The bank is in essence a high-speed market follower, not a market maker for retail customers. So, if banks are just reflecting the market, why all the mysterious maintenance alerts and system updates? This is where speculation often diverges from reality. When your banking app displays a message saying it's under maintenance, or that foreign exchange services are temporarily unavailable, it's overwhelmingly likely to be part of routine, necessary technological upkeep. In the complex world of modern finance, bank systems are not static. They require constant patching, updating, and synchronization. This is often just the IT department ensuring that the bank's data feeds are correctly aligned with the global feeds, or applying a security patch to protect against cyber threats. These routine operations are a normal and essential part of digital banking. Banks must constantly refresh their compliance tables, update their anti-money laundering protocols, and ensure their software is compatible with the latest international standards. These updates are scheduled work, much like road maintenance. While it may cause a temporary slowdown or outage, it doesn't mean a new city is being built. In the same way, a bank's system update doesn't automatically signal a major economic shift or a revaluation. It's simply the necessary work required to keep the highly complex, interconnected, and heavily regulated financial machinery running smoothly and securely. This brings us to the specific case of the Vietnamese dong. There is a clear reason this currency has captured so much public attention, and it has nothing to do with secret bank memos. The focus on the dong is rooted in Vietnam's undeniable economic success story. For decades, the country has been on a steady growth trajectory, transforming its economy. It has successfully positioned itself as a critical hub for global manufacturing, particularly in electronics, textiles, and exports that flow to markets across Asia, Europe, and North America. This economic rise is not a rumor, it is a verifiable fact tracked by economists worldwide. The tangible evidence of this growth is significant. Major multinational corporations, including household names like Samsung, Intel, and Apple's manufacturing partners, have invested billions of dollars to expand their operations within Vietnam. This influx of foreign direct investment is a powerful vote of confidence in the nation's stability and its future potential. As a result, financial analysts and long-term investors have naturally taken a closer look at the country's economic fundamentals and the long-term potential of its currency. The Vietnamese dong, therefore, has become an interesting case study in global finance, representing a stable, albeit tightly managed, currency backed by a rising trade powerhouse. This is precisely where the misunderstanding and the rumor mill begin to churn. When these routine bank software updates or rate feed synchronizations occur, they sometimes involve technical adjustments to the lists of currencies in the system. Observant individuals may notice the Vietnamese dong code VND appearing on a list or being part of an update log. Screenshots of these backend systems or test environments are often captured and circulated online, presented as proof that something big is about to happen. This is how a simple, mundane technical procedure is misinterpreted and transformed into a speculative event, fueling a narrative of impending, dramatic change. The conclusion, jumping that follows, overlooks a critical distinction in banking technology: the difference between a currency being listed and being tradable. A bank's internal database is a massive, comprehensive catalog. It must contain the official ISO currency codes for hundreds of global currencies, many of which the bank may never offer for public exchange. This is a matter of simple data architecture. The bank's system needs to be able to recognize the code for the Vietnamese dong, the Iraqi dinar, the Lao kip, or the Rwandan franc, even if it's only for internal accounting, regulatory reporting, or tracking international wire transfers. Think of a bank's currency database like a digital phone book for the entire world. The book contains the name and number for everyone, but that doesn't mean the bank intends to call everyone. Similarly, a bank's system listing the dong just means the code is in the database. It is not an active, tradable asset for the public. Many of these currencies are marked internally as inactive, restricted, or for internal use only. This is the standard operating procedure for every major financial institution. It is not a secret signal, it is a structural requirement of a global database. To illustrate this further, consider an app on your smartphone that you have installed but never opened. The phone's operating system recognizes the app, it's listed on your home screen, and it receives technical updates, but it is not active. It's not in use. A currency code in a bank's backend is the exact same concept. The system recognizes it and it gets updated during routine maintenance patches, but it remains inactive for public-facing exchange. This simple technical reality explains the vast majority of screenshots that circulate online. They are glimpses of a database, not a trading desk in waiting. So, what would actually have to happen for a U.S. bank to begin offering widespread public exchange for a currency like the Vietnamese dong? The process is far removed from a secret software update. First and foremost, the change would have to originate from the currency's home country. The State Bank of Vietnam, its central bank, would need to make a significant public and official change to its own monetary policy. This might involve adjusting its currency management, allowing for broader international trading access, or changing the currency's official status on the global market. This hypothetical policy change would not be a secret. It would be announced to the world. Only asterisk after asterisk that official declaration and asterisk after asterisk the new rate or status is published through official global market channels. The same data feeds we discussed earlier would U.S. banks even begin the process of updating. They would then react to this new public information by updating their customer-facing systems to reflect the new verifiable market reality. The bank's update is the last asterisk step in the chain, not the first. Until that official, public and verifiable change occurs, no commercial bank can legally or operationally offer an exchange outside of existing approved channels. It is also vital to remember the strict regulatory environment in which U.S. banks operate. Large institutions like Bank of America, Chase, or Wells Fargo are not independent actors. They are heavily regulated and supervised by federal agencies, including the Federal Reserve and the Office of the Comptroller of the Currency (OCC). These regulators enforce strict rules designed to ensure the stability and integrity of the financial system. Banks are explicitly prohibited from speculating on currency movements or using non-public information to pre-announce exchange rate changes. This regulatory framework is why claims of a bank insider or a teller confirming a pending revaluation should be treated with extreme caution. Every single foreign exchange rate a bank displays to the public must match the verified official global data. Bank employees are bound by federal confidentiality and compliance rules. They are not privy to secret, upcoming currency revaluations. Sharing such information, if it even existed, would be a serious violation. The system is designed for transparency and stability, not for secret insider tips. Let's now zoom out and look at the bigger picture, because there is a major change happening in global banking, and it's the real reason for all these updates. Since 2023 and accelerating into the present, many U.S. banks have been in the midst of a massive once-in-a-generation upgrade of their entire foreign exchange and cross-border payment infrastructure. This isn't about one currency, it's about modernizing the entire network. Banks are aligning their systems with new global standards, most notably ISO 20022, which is a new highly detailed financial messaging system. This upgrade to ISO 20022 is a significant undertaking. It's akin to upgrading the entire plumbing of the global financial system to a new, smarter and more data-rich standard. Alongside this, banks are also integrating faster payment rails like SWIFT GPI and even exploring new blockchain-based settlement platforms. When banks undertake these monumental technology projects, they must update their internal frameworks from the ground up. This asterisk frequently asterisk results in temporary outages, under-maintenance notices, and system-wide patches, the very things that get noticed by the public. The updates are real, but they are about technology, not a specific currency. This trend of modernization is not limited to the U.S. In fact, Vietnam is pursuing a parallel path of financial modernization with equal vigor. The Vietnamese government and its central bank have been actively integrating new digital payment systems, strengthening their anti-money laundering AML policies, and working to improve the overall transparency of their financial sector. These are not secret moves, they are public, measurable reforms. These are the exact steps a nation takes when it wants to deepen its global economic integration and attract more stable, long-term investment. This is the real reason why sophisticated financial observers are optimistic about Vietnam's long-term growth. The optimism is not based on rumors of a sudden, overnight currency jump. It is based on the solid, measurable, and difficult work of economic and financial reform. When a country builds a stronger, more transparent, and more modern financial system, it builds confidence. That confidence, in turn, fosters a more stable and reliable economic relationship with the rest of the world, including with major trading partners like the United States. What, then, drives a currency to strengthen in the real world? It is not a hidden decision made in a back room or a secret software patch. A currency's value is a reflection of its nation's economic health and performance. A currency strengthens when its country's gross domestic product (GDP) grows consistently, when its exports are in high demand globally, and when its inflation rate remains low and stable. Most importantly, a currency's value is built on the confidence of international investors that the country's future is stable and promising. Vietnam, for example, has been working diligently on all of these fronts. The economic ties between the United States and Vietnam illustrate this point perfectly. Over the past decade, the relationship has deepened significantly, and the U.S. is now one of Vietnam's largest and most important trading partners. This robust trade relationship benefits both nations, and it relies on a stable and predictable currency relationship. This is another practical reason why U.S. banks keep the Vietnamese dong listed in their databases. It is a recognized international currency from a major trading partner, even if retail exchange access for the public remains limited by market and policy constraints. This leads to a final crucial question. If everything is so regulated and transparent, why do these rumors spread so easily and so fast? The answer has more to do with human psychology than finance. People are naturally drawn to the idea of hidden opportunities, of being in the know before anyone else. The thought that one might be early to a life-changing financial event is incredibly compelling. This mindset, however, makes many people vulnerable to financial misinformation, especially in the anonymous and rapid-fire world of social media. Stories of sudden currency revaluations have circulated for decades, often preying on this hope. This is why, now more than ever, it is essential to rely only on verified, public, and credible sources of information. To stay informed, the smartest approach is to track official statements from their source. This means monitoring the State Bank of Vietnam, the International Monetary Fund, and the official publications from your own financial institution. You can also use legitimate, real-time exchange rate trackers and major financial news outlets like Bloomberg or Reuters. If a major change is happening, you will see it there publicly, officially, and verified by multiple sources. If you don't see it there, it's not official, regardless of what screenshots might be circulating. So, let's circle back to the main question: are U.S. banks secretly preparing for a Vietnamese dong exchange? The truthful answer is that U.S. banks are already prepared. They handle complex foreign currency exchanges every single day as a core part of their business, but they do so strictly within the limits set by international markets and regulations. If the Vietnamese dong status ever changes officially, those same banks will simply follow their established procedures. They will receive the new public data and update their systems accordingly. There is no need for secret preparation because this is what they are built to do. As we wrap up, let's be clear. There is nothing magical or secretive happening behind the digital curtain at your bank. The maintenance alerts and system updates you see are not clues to a hidden puzzle. They are signs of progress. They are signs of modernization, of necessary compliance updates, and of financial systems being improved to handle the next generation of global trade. This process naturally includes currencies like the Vietnamese dong, which is simply a reflection of the growing strength and integration of Vietnam's economy in our interconnected world. The truth is far simpler and frankly far more interesting than the rumors.